Hello, fellow traders, and welcome to another exciting episode of Forex here. Today, we're taking a deep dive into a critical aspect of the financial markets that every trader should be well-versed in. Inducement zones. These elusive zones on the price chart are meticulously designed by institutional players with a strategic intent to entice unsuspecting traders into their traps. Inducement zones serve as a concealed weapon wielded by institutional players to sway market sentiment, and unfortunately, they can transform a seemingly promising trade into a nightmarish ordeal. In this video, we will unveil the mysteries shrouding these inducement zones, delve into how they operate, and, most importantly, provide you with the knowledge necessary to shield yourself from potential losses. Traders, if this topic piques your interest, please show your support by giving this video a thumbs up, and consider subscribing to our channel if you're new here. Welcome back, traders. Let's dive right in. Inducement zones, also known as liquidity zones, are specific areas within the market where participants are encouraged to initiate or conclude their trades. These zones come into existence due to the substantial presence of liquidity. They typically signify regions where there is a notable influx of buying or selling activity. Consequently, inducement zones can offer valuable insights into potential market reversals or ongoing trends. The term inducement in the context of financial markets can be precisely defined as follows. Inducement zones are specific junctures or regions within the market where traders perceive it as an opportune moment to initiate a trade. Their decision is informed by their analysis and adherence to a specific trading system. These zones serve as strategic tools utilized by central banks and prominent financial institutions for the purpose of manipulating and enticing retail traders into their carefully orchestrated schemes. The primary objective behind enticing traders into these zones is to stimulate liquidity and draw in more buyers and sellers. Once a critical mass of retail traders has entered positions aligned with what they perceive as a favorable market direction, the tables are swiftly turned, leading to a substantial reversal or breakout. This abrupt shift often catches many retail traders off guard, triggering stop-loss orders and further contributing to the liquidity that smart money players aim to capitalize on. In most cases, inducement zones tend to manifest at precise points and regions within the market. These areas often encompass what we refer to as order blocks. These are regions where substantial orders have either been executed or where pending orders are clustered, making them significant liquidity zones. Consequently, inducement often occurs within these order blocks. They serve as the perfect setting for market manipulators to orchestrate false moves or reversals, deceiving traders and enticing them into taking positions. For instance, as illustrated here, after the formation of bullish order blocks pushing the price upwards, there was a sudden shift in momentum leading to a downward movement. This movement tapped into the upper bullish order block, and although there was a brief pullback to the upside, the price then sharply dropped. It's evident that the market didn't adhere to the upper order block as expected. Instead, the price swiftly dropped, triggering the stop-loss orders of traders who had entered the market at this level. Having successfully swept the liquidity resting below this zone, the price utilized the upper zones as inducement levels. It then reversed direction from the extreme order block, embarking on a robust upward movement, sustaining the bullish trend with considerable momentum. The second aspect to consider is dynamic trendline and channel breaks. Inducement can take place when a dynamic trendline or channel is breached, which often convinces traders of an impending strong directional move. However, it's essential to be aware that market manipulators may capitalize on these breakouts as an opportunity to trap traders before subsequently reversing the price. When a trendline or channel is breached, it tends to generate a sense of urgency among traders, compelling them to enter positions aligned with the breakout direction. However, it's crucial to be mindful that market manipulators may engineer a false breakout to stimulate a surge of buying or selling activity before executing a reversal in the opposite direction. In the chart example provided, there's a bearish dynamic trend line that the price has consistently respected on multiple occasions. This trend line has effectively created a substantial liquidity zone just above it. This liquidity accumulation is a result of the stop-loss orders placed by traders who entered the market with sell positions, expecting the price to reverse to the downside each time it touched the trend line. These traders also anticipate a buying opportunity if the price were to break the bearish trend line to the upside. However, as illustrated, the price was artificially pushed upward by market makers employing a large red momentum candle. This abrupt upward surge led to the sweeping of the significant liquidity that had gathered above the trend line. Consequently, stop-loss orders of retail traders who had short positions were triggered. Additionally, this breakout generated excitement among more traders, convincing them that it was the right moment to ride the upward wave. They placed their buy orders and entered the market while also adjusting their stop-loss orders just below the trend line, creating a potential target for the price. Nevertheless, as demonstrated, the price swiftly reversed direction and moved downward with considerable momentum candles. In this orchestrated scenario by market manipulators, both buyers and sellers saw their stop-loss orders triggered. This allowed the market to absorb a substantial amount of liquidity, fueling its momentum in the process. Another factor to consider is support and resistance levels. Inducement can take place in proximity to significant support or resistance levels. Market manipulators might orchestrate false breakouts or reversals around these key levels to deceive traders into entering positions before executing a reversal in the price. Let's examine an example to understand how large financial institutions, such as banks, utilize inducement zones to manipulate the market and ensnare unsuspecting traders. Look at this resistance level here, and notice how the price approaches it but faces a strong rejection. This isn't a coincidence. Banks are well aware of how retail traders think, and they exploit this knowledge to their advantage. Imagine you're a novice trader, and you witness this breakout. It's exhilarating, and you decide to jump in thinking it's your opportunity to ride the upward wave. But here's the twist. The major market makers nudge the price up slightly, just enough to trigger the stop loss. Orders of traders who had entered the market with sell positions based on the resistance level. This scenario boosts traders' confidence even more, drawing them into the market. And guess what? Other novice traders join the movement too, placing their stop-loss orders below the resistance level, simply following the crowd. However, the price subsequently closes below the resistance level, leaving traders fearful and uncertain about the market's direction. Other banks also recognize this as a trap and manipulation, and they join the movement. As you can see, the market starts heading down, aiming for the liquidity zones created by the stop-loss orders of traders who had entered with long positions during the breakout. Ultimately, those who fell into this trap incur losses. Number 4 on our list is Fibonacci retracement levels. These levels are popular among traders for identifying potential reversal points. Inducement may occur at these retracement levels to deceive traders into taking positions before a price reversal. As you can see in this chart, the price formed a bullish break of the structure by surpassing the previous higher high, leaving an inefficiency behind. When we add the Fibonacci retracement tool, we can observe that the price initially showed a slight reaction at a commonly used retracement level. However, it swiftly reversed and moved downward, triggering the stop losses of traders who had entered long positions based on these retracement levels. Subsequently, the price tapped into the extreme order block and reversed its direction, moving back up again. Another scenario where inducement can take place is during the breakout of consolidation patterns. Inducement may occur when the price breaks out of a consolidation pattern, like a range or a triangle. Traders might perceive such a breakout as a strong signal, leading them to enter positions. However, market manipulators can reverse the price direction after trapping traders. In this example, we can see that the price was in an accumulation phase, consolidating within a range. However, it was intentionally pushed downward, creating a false impression that the ranging market phase was ending and a bearish move was imminent. This induced traders to enter the market with short positions, expecting a downward continuation. However, the price cleverly used the accumulation phase as an inducement, creating a fake breakout below the consolidation range. It swept the liquidity from the sell side and then swiftly reversed direction, experiencing a strong upward momentum. Inducement zones can be found at swing highs and swing lows, which are levels where market manipulators may deceive traders by engineering false breakouts or reversals. Market manipulators can take advantage of news events or economic data releases to trick traders into making decisions based on the initial reaction to the news. They may create false movements or exaggerated price swings to trap traders before reversing the price direction. Now that we've thoroughly explored inducement zones that commonly appear on real price charts, we can build a solid understanding of how to detect them. It's time to delve deeper into the concept of inducement from the perspective of smart money. So let's proceed to the next topic. Before we proceed to analyze real price charts and explore how to identify inducement zones and incorporate them into our trading strategies, let's take a moment to grasp the theory behind inducement from the perspective of smart money. This foundational understanding will enable us to comprehend how price movements unfold within the market. To illustrate this concept, let's consider a bullish market structure. The current scenario depicts an uptrend following a robust upward rally. Subsequently, the price undergoes a retracement or pullback to the downside. This retracement is typically perceived as a temporary pause or consolidation within the broader bullish movement. It occurs as selling pressure diminishes, allowing bullish momentum to regain strength. Consequently, the price is poised to continue its primary upward trajectory. In the continuation of this trend, the price makes attempts to move higher but encounters resistance. It establishes an internal high and experiences a minor pullback to the downside. However, with increasing bullish momentum, the price makes a strong upward move, breaking the previous structure resistance and establishing a new higher high. Now, we have witnessed a break of structure to the upside and the emergence of a demand zone associated with this break, holding the potential to reverse the price. It is essential to note that there is another nearby zone that remains untouched, potentially causing confusion among traders when deciding which zone to trade. As we've discussed previously, inducement areas are strategically crafted by large financial institutions and smart money traders, including central banks. Their objective is to deceive retail traders into taking buy or sell positions in the market, ultimately generating more liquidity for themselves. In this particular case, the order block can be considered an inducement level. Market makers or significant players manipulate the price action to construct a structure that misleads traders into anticipating a price reversal to the downside. Consequently, many traders enter the market with sell positions, expecting a bearish move. They place their stop-loss orders above the internal high, anticipating the price to honor the structure and reverse lower. However, market makers have different intentions, and the price eventually surges to the upside, triggering the stop-loss orders of those with short position. This activity provides liquidity for the market maker's buying activity, resulting in a sharp upward movement. Additionally, this manipulation leads to the formation of a fake demand zone within the order block. It becomes evident that the price was artificially manipulated to deceive traders and generate more liquidity for large smart money traders, including central banks and major financial institutions. Subsequently, the price continues its downward trajectory and reaches the previously identified inducement zone. As anticipated, a minor pullback to the upside occurs, driven by the buying pressure of traders who entered the market with long positions from this zone. This pullback may create a sense of reassurance for other price action traders, prompting them to enter the market with long positions as well. They position their stop-loss orders below the inducement zone, believing it will serve as a significant support level. Identifying a liquidity sweep pattern that precedes the price reaching our area of interest is of utmost importance. This pattern signifies the absorption of liquidity and offers a chance to validate the strength of demand within our designated area. We utilize liquidity sweeps as a confluence factor before entering a trading position. The underlying theory behind this approach is that the market relies on liquidity to maintain its movement. If the price neglects to sweep liquidity before reaching an area of interest, there exists a substantial likelihood that the price will utilize that specific zone as a source of liquidity to propel its momentum. This collective trading activity results in the establishment of a clearly delineated liquidity zone positioned just below the inducement zone. Within this zone, traders have positioned their stop-loss orders. These stop-loss orders serve as potential sources of fuel for the market's momentum. In fact, the price effectively swept the liquidity situated behind the inducement zone, thereby confirming the expected confluence. Our next step involves monitoring the price as it enters the higher time frame demand zone. Once the price action is drawn into the higher time frame order block, we shift our focus to the lower time frame. Within the higher time frame demand zone, we search for a change in character on the lower time frame. Additionally, we identify a new order block, which in this case is a demand zone on the lower time frame. When these conditions align, we consider a long opportunity with our target set at the external liquidity level, serving as the take profit level. Now that we have a general understanding of how inducement zones can be used in our trading plan to enhance profitability, let's explore the potential scenarios that may unfold when the price reaches the inducement zones. There are two potential scenarios that may occur when the price taps into the inducement zones. In the first scenario, we observe that the price reaches the inducement zone and initially shows a slight reaction. It then continues to move below or above the inducement zone, sweeping the liquidity that has accumulated in that area. However, the price eventually closes within the inducement zone, confirming the formation of a valid bullish or bearish POI pattern. To safely enter the market, it is advisable to wait for confirmation on a lower time frame. This confirmation serves as a signal that validates the trading decision. Without such confirmation, it is best to refrain from initiating any position. In the second scenario, the price enters the inducement area and initially reacts slightly. However, instead of respecting the inducement zone, it disregards it and continues its movement. This disregard leads to the triggering of stop losses placed above the inducement zone, resulting in a liquidity sweep pattern. Subsequently, the price continues its movement towards the next order block zone located at the extreme. As mentioned earlier, the presence of a liquidity sweep pattern before the price reaches our area of interest offers a high probability entry opportunity. This pattern signifies the absorption of liquidity and serves as confirmation of the strength of the identified demand or supply zone. By recognizing this pattern, we can seize the opportunity to enter the market with increased confidence. Now, let's switch to a real chart and examine some actual inducement examples. On the screen, we have the 15-minute chart of the pounds to dollars currency pair, which is currently in a strong downtrend. We can identify a bearish break of structure where the price breaks and closes below a previous lower low. The chart shows two potential supply areas where the price could potentially reverse and resume its bearish trend. However, the key question is how we can determine which of these zones is safer to trade and more likely to be respected by the price. Upon closer examination, we can see that the price failed to break the recent low in a single downward movement. Instead, it formed an internal low, followed by a minor pullback to the upside. Subsequently, the price gained significant bearish momentum and experienced a sharp downward movement, ultimately leading to a break in the market structure. Consequently, we have identified a break of structure and two potential supply zones associated with the break. These zones have the potential to trigger a price reversal. One of the supply zones is located at the extreme end, while the second one is in proximity to the break of structure. As mentioned earlier, this zone can be considered an inducement zone. One reason for this is that the price deliberately created a structure that would deceive traders into believing that the price was about to change direction to the upside. However, as observed, this zone induced traders to enter the market with buy positions and place their stop losses below the internal low. But the price subsequently moved sharply downwards, triggering those stop losses. Secondly, this zone appears to be a perfect bearish order block for smart money traders. Many smart money traders are likely to place their sell orders in this zone and also set their stop losses just above it. As a result, a significant liquidity pool is created just above the zone. As previously mentioned, inducement zones are strategically designed by large financial institutions, such as banks, to deceive traders into taking buy or sell positions in the market, ultimately generating more liquidity for themselves. Now, let's see what unfolds next in the price action. As you can see, the price initially moved upwards and reached the inducement zone, luring in more traders to open sell positions due to the temporary pullback. This pullback gave the impression that the supply zone was respected and that the price would reverse downwards. However, contrary to expectations, the price sharply pushed upwards, sweeping the liquidity above the inducement zone. Eventually, after mitigating the extreme order block, the price reversed and continued its primary bearish direction with significant momentum. Now let's look at another example. Again, we have the 15-minute time frame chart of euro to dollar. As you can see, the price is in an upward trend and has formed a series of upward movements. In this context, we can identify potential demand areas where the price could potentially reverse and continue its upward trend. However, the fundamental question remains: how can we determine which of these areas are safer to trade and more likely to be respected by the price? As we said earlier, we only consider an area valid for trading when a liquidity movement pattern has occurred below or above it. In this case, I would not consider this particular decision order block as my area of interest because the price did not liquidate before reaching it. Instead, I see it as a motivational area that creates an underlying liquidity pool in the market. As you can see, after forming a new higher high, the price experienced a strong bearish move towards the upper order block. At this stage, the price showed a slight reaction towards the induced zone, influenced by the buying pressure of traders who entered the market, believing that the price would reverse from the high demand zone. However, contrary to their expectations, the price resumed its downward movement and effectively overwhelmed the liquidity accumulated below the trigger zone, mainly due to the stop loss of traders who had long positions from the high order block. Furthermore, we can see that after touching the order block, the price reversed and started a significant up movie to clear the buy-side liquidity. We classified the top order block as an induction zone because there was no liquidity movement pattern before the price reached it. As a result, the price did not reverse out of this zone, but instead used it as a source of liquidity, gaining momentum in the process. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated with our latest videos. We value your feedback and suggestions, so please leave a comment below and let us know what tips you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.